Hey traders, welcome to our weekly Sunday show. Great to see everyone. Hope everyone's enjoying their long weekend. Doesn't mean that we're not going to take a look at the way in which we open here on Sunday, even though we have a holiday tomorrow. The futures markets are moving, albeit with definitely less volume and less attention, but nonetheless, it's going to give us some price action to take a look at before we get to Tuesday and the beginning of the week. A couple things to keep in mind as we take a look at what we're going to be dealing with. And of course, I do like to stop at the calendar for the week, taking a look at what we're going to deal with. These are the data points, these are the events that are going to be catalysts. And when stitched together, they give us a better idea of the trajectory of, well, in this case, the macroeconomic events. What do we have coming up this week, this shortened week? Not a whole heck of a lot obviously not a whole heck of a lot to be said for Monday, but going into Tuesday, we have the ISM services PMI rolling into Wednesday, two FOMC speakers at 10 a.m. and then another one at 2. So definitely a lot of Fed speak on on Wednesday. We roll into Thursday. This is where it gets interesting. We've got the ECB. So if you do have US dollar or euro exposure for those currencies, heads up, because the ECB press conference, as well as the ECB rate statement and their refi rate, everything's going to be hitting on Thursday morning quite early, starting at 8:15. And then, as if that isn't enough, as really the second most important central bank having their day isn't enough, we had Fed Powell speaking at 10 after 9 on Thursday. So heads up, Thursday is going to be a heck of a day. We want to keep the Dramamine handy for Thursday. And then Friday, to end the week, 2 more FOMC speakers. So not a lot by way of data, but tons of Fed speak. If they want to walk anything back, if they want to accelerate anything, this is going to be yet another opportunity for them to do so. All right, so that's the calendar, and that is what we're going to be dealing with so far on the open. We recovered quite a bit. It was a heck of a bounce going into the final moments of the Wall Street day and then into the futures close. Decent little bounce we saw, and seems to be for the most part holding. It's clearly very, very early, but we seem to be holding about where we closed on Friday on this very illiquid Sunday to Monday transition. All right, so as always, we'll take a look at more of these charts as we go through the questions, and I definitely want to get to those with you all. Of course, if you have any particular symbols you want to take a look at, let me know. We'll go ahead and see what's happening on the price chart and whether or not those are going to be influenced by any visible trend on the chart, or will they be impacted by any of the events. Remember, US dollar, bonds, gold, and clearly the broader equities are going to be affected by a lot of the Fed speak that we have coming up this week. Again, culminating with Powell this week. All right, let's get to it. First question we have there. Hey, RF, do I think the recent run-up was a bear market rally and the trend is down for the long term? If so, how does someone from getting caught in that? Oh, don't get caught. All right, so RF, again, what we can do as traders and or investors, and this is really important. I'm so glad you kicked this conversation off with this question. The main thing that we do as traders and investors is know the game that we're playing. If I'm a trader, if I'm a day trader, I don't even hardly care. That's the freedom of it, to not have to worry about it. I don't usually care what happens after noon Eastern, because my window is such a small 2-hour window on a 5-minute time frame. All right, so let's move to more of a swing trading type time frame and time horizon. So I'm usually going to be looking at the daily time frame with a few days to a few weeks in terms of a time horizon. Once we get out to trend is down for the long term. So RF, I totally hear what you're saying. Just out of good habits, break it down to the time frame, right? Is that a daily? Is that a weekly? Or is it a monthly conversation? I don't have monthly conversations. Monthly conversations are for clickbait. Monthly conversations are for those conversations that we have that really don't have any trackable time horizon. If someone says that something's going to happen in the next 6 months to a year to 2 years to 3 years, what are we going to do with that? Put in a position now? That's why I say it's clickbait. I will not look at a monthly where each candle is 1 month. The longest time frame that I will look at for my longer term portfolios is the weekly, where I get one fresh candle every week. Remember, gang, a lot of folks love all the speculating and conversations about these hyperbole type moves. We're going to head to new significant highs. We're going to head to new significant lows. But the fact of the matter is, our job is to pick a time frame, understand the time horizon associated with that time frame, and pick a spot from which to enter the market. And then with that in mind, we think of a target, we think of a stop loss. Any conversations that don't have those pieces, gang, is just meant to rile you up, scare you, impress you, and whatever other nonsense, but it's not trading and it's not investing. I hope that makes sense. So is the trend down for the long term? So RF, the question then becomes, what's long term? 6 months, a year, 3 years? I'll tell you this. If given time, the markets are designed over time to move higher. The scary, oh my gosh, the markets are going to crash stuff gets our attention because that's lizard brain stuff, right? Now, the idea that the markets continue to move higher, if you go back and dissect any 7 to 10 year, I think it's a 10-year, but really probably works at 7 years too when I think about it. Any 7 to 10 year period that you can go back to, I believe it's World War II, generally you're going to either be flat or you're going to be up on that window. So there is a predisposition for the market to move higher, which I believe is, as an investor, how I want to give myself the benefit of just leaving things alone. There's a really, it's a little, it's true, but it's a little morbid. When brokerages talk about some of their accounts that have moved the most, that have done the best over time, and therefore I'm talking years, they're usually of accounts. I know this is morbid, but it should teach us something. They're usually of accounts of people who have passed. They've passed, therefore they're not in there moving things around, waiting for a big crash, buying a new high. They're just in the market. Whatever positions they had, that's what they've got. And brokerages come out from time to time and say some of our best accounts are from people who have passed, and the accounts haven't been, messed around with, fooled around with. That's very telling. So there's a funny little window between where we stop being traders with that few days to few weeks time horizon, and we start thinking maybe 6 months to a year plus. So I'm presuming it's the latter you're talking about. And so then we have to talk about what a bear market means. A bear market is usually what, 20% from the highs, some arbitrary number like that. I don't worry about whether a market's in a bear market or not. I want to look at the underlying trend. So this is really more of a daily and weekly time frame. And I'm sorry for the huge lead up, but it really does mandate my telling you what it is that we're looking at, because otherwise, well, then I'm just as guilty as the clickbait nonsense of anybody bringing up monthly charts to talk about time horizons that are years or two out. Unless there's an entry, a target, and a stop, it's just really designed to, like I said, scare or impress. You'll see this on television all the time. Are the weekly charts in a downtrend? For example, on the S&P, they're actually not. Are the daily time frames in a downtrend based on the 8, 13, 21, and 34? They're not. So bear markets, well, there's this widely accepted definition of, I think it's 20%. That's how much I use it. I don't even know what the definition is, but there's that definition of 20% from the highs is a bear market territory. Why not 19? Why not 22? You see what I mean about the arbitrary nature of it? I don't have a downtrend. Therefore, I don't look at it as a bear market. How do you prevent getting caught in it? Know when the market's in a downtrend and don't buy the dip. Don't confuse lower lows for a dip in a downtrend. If the market's in chop, as they are right now, look for oversold buy levels. And if those levels don't hold, and then we organize into a downtrend, that knowledge of what the underlying market structure is on a daily or a weekly is going to be your best. It's going to be your best defense in terms of not buying markets that are in downtrends. That's my take. The way I look at it, gang, and look, where am I coming from? I'm coming from, as of this year, 33 plus years in the market. Wars, implosions from hedge funds, bubbles, numerous bubbles. After a while, you find, whether it was long-term capital management or the Archegos implosion, it's pretty much the same thing. Change the names. Whether it was the 2001 tech bubble bursting or whether it was '08, believe it or not, while the scales were different, it's kind of the same conversation, just some of the details and sort of the characters, a little bit of the narrative, a little bit different. As people like to say, I love this, history doesn't necessarily repeat itself, or people don't necessarily exactly repeat themselves, but it sure does rhyme, right? There's a lot of similarities. So I'm going to trust that the versions of different implosions, crashes, whatever, that I've seen before, are they usually different circumstances? And right now, absolutely. Very different circumstances. I've been asked a lot whether or not this is like '08. This is nothing like '08. This is nothing like '08. This is what it feels like when a prolonged period of accommodation is being unwound. This is what it feels like, when we're seeing a significant central bank monetary policy shift. What an awesome question to kick it off. We'll pick up the pace a little bit, take more questions, but what a great question, because what I just laid out, gang, is really the foundation of the way that I have invested and traded for decades, right? And it just scales out and works. And it's not getting too much into the crystal ball of what's going to happen. It's just, what do I see happening now? And what does it mean to me? And is there an opportunity with what I see, or should I just kind of stay on the sideline, or maybe shorten the time frame? All right. Thank you for that. Thank you very much for that. Furman, how are you? Daily structure on the ES and NQ is now red momentum and yellow trend. Right. So momentum is very different than trend. Not unusual to see some bearish momentum with some red grab candles, but it's bearishness within a neutral trend. Exactly. Does that increase the probability to test June lows? No clue. Furman. So again, what that's asking is, can we see the future? Anytime you're asking yourself to see the future, you're asking anyone on this side of the camera to see the future. We're coming up into football season. So I'm going to ask you, who's going to win? Who's your favorite team? Are they going to win the week 2 game? And what's the score? And you're going to say, Rog, I don't know. All I can tell you is that they're going to play this team. That's all we can do as traders too, as investors. So is there a probability to test June lows? All I can tell you is if we continue to move lower and lower, there's a probability to take out near-term lows. Whether we go back to June, gang, it's anybody's guess. Could we, if we keep going lower, make a test of 3640? We could, but remember, previous support doesn't mean that's where we're going. It just means that if we get there, price could hold. So let me say this again. Previous support is not a projection of where we're heading. Previous support is saying that if we get there again, prices could hold. So I have no idea, Furman, but here's what's really cool. You don't have to either. As traders, we can react to price action and make decisions about where we are right now. Because, by the way, Furman, what if I said yes and increased the probability? Does that give you a trade? No, my friend. It just gives you maybe a target. And a lot of folks want a projection, whether we're going to 4,300 or we're going to 3,700, right? They want that projection because then they think, well, at 3,900, if we're going to 3,700, that's 200 points and I'll take that trade. That's not a trade. Remember, gang, targets are not trades. So if I say we're going to 4,300, what if you go to 3,800 first and then go to 4,300? You see what I'm saying? So even though we might put out a target, which you'll never see me do, but even if we have a target out there, how we get there is even more important as whether or not we get there. So I hope that makes sense. Great question to kick off the session. All right. Next up is, let's see. How's the birthday weekend going? Hey there, Alan. It's been really good. It's been really good. In fact, I've been thinking a lot about this coming week in the market, this coming week of the kind of things that I would love to help sort of dispel the myths and take a lot of the hyperbole and just this ridiculousness that I'm seeing. Yes, the markets are weak, and they're after the run up we saw in most of August. It's disappointing to see us take it back. But we're not even lower than we were, but, barely, but about 5 or 6 weeks ago. And it's really interesting how when an uptrend is broken, just how quickly the sentiment turns to straight up panic. It wasn't as if we were chopping, because if we were chopping, traders would have been irritable, investors would have been irritable, but there wouldn't have been that panic. When we break an uptrend, it's fascinating how quickly the psychology shifts to the worst case scenario. It's really, really interesting to watch. And I'm sure a lot of you have observed the same thing. The trick is not to get engaged. And I've been thinking a lot about that mental side of things a lot this week, Alan. I'm looking forward to next week a lot with you all in the rooms. Long trend charts for gold and true rates tend to confuse me. Just watch the black and gold line. Do I have that up? I don't know that I've got. Let me see. Do I have long term? So if you're talking about this chart right here, the real interest rate, the inflation rate. So I don't know when they're black and gold. On mine, it's red, blue, and white, and it should be defined. So as the inflation rate moves higher, and the interest rate of a bond moves higher with it, you want to know what that chasm is between it. When that chasm gets larger, in other words, it gets higher, right? It's a higher number. That's going to be downward pressure on gold. When that chasm between nominal interest rates, the yield of a bond, and the inflation rate gets narrower, in other words, the number gets smaller, that's bullish for gold. And that's it. That's the way that I look at that. It's a tendency. Gold moves inverse to real yields. Always has, always will. It's not a safe haven. It's not a flight to safety. It's really a playoff inflation and bond yields. And when you subtract those two numbers, what you get is something called real yield or real interest rate. So thank you for the question. Hope that helps. Hey there, Nick. How are you? Let's see here. Is there a set of teachings I can find somewhere that summarize my approach to trading? I do a lot of classes. I've been doing classes with Simpler since on and off since 2014, 2013, whether that be Forex, futures, day trading, ETFs, swing trading, volume trading. I have a number of classes. Is there somewhere to a summary? I can't say that there is. Nick. Yeah. I think that what I try to do is use the same tools, right? So you'll notice every one of those styles, I'm using the same tools more or less. There's always going to be grab candles on my chart. There's always going to be a wave on my chart. I'm always going to be talking about things like market structure via the 8, 13, 21, and 34. Some things are really consistent. We're going to talk about volume and time. We're going to talk about volatility. So the tools are really consistent. The setups are really what changes. Okay. So is there a way to summarize it? There's way too much nuance, Nick. Yeah, there's way too much nuance. But what we've done with each one of the classes is we've done a deep dive into, all right, Raghee's tools. Here I am talking about myself in the third person, which is kind of ridiculous. But here's Raghee's tools. Here's how she uses them with swing trading, with ETF trading, with day trading, with, fill in the blank, volume trading. So that's what we try to do with the classes that we do here at Simpler. Hope that helps. All right. Oxy or MPC or XLE. I am group, which is a better daily chart to go long. Well, let's start with a broader group. Let's start with XLE. I feel a sneeze coming on. I'm trying to fight it off. Okay. XLE. So I do not like, so Groot, I am Groot. Here's what I would say. A lot of what's going on in the broader energy conversation is really much more natty than it is crude. So I would not really look at XLE as much as I would look at the stocks weighted within the FCG. And then that's where, when you start looking at Occidental, it's weighted within that XOP FCG corner of the market. Yeah, XLE is moving higher, but this is only going to do as well as Exxon and Chevron led it. So XLE is only going to do as well as Exxon and Chevron allow, because those are by far your two most heaviest weighted stocks. XOP and FCG don't have as much high concentration weighting, and I really do like that corner of the market a little bit better. But as far as Occidental and MPC, let's see, MPC. I like them both. Yeah, I like them both. They're both, take a look at Occidental, double green on the daily, and MPC, double green on the daily. So I do like them both. Yeah. Daily data asks, buy the dip. What happened to that? Nothing nothing daily data. When we talk about buy the dip, remember, buy the dip is valid when we have a trend. See, buy the dip is not just something we arbitrarily apply to everything, right? Buy the dip is applicable to any time frame that has what I call a double green uptrend. So when we have an uptrend, the dip is really just sort of jargon, slang, if you will, for a regression to the mean, right? Dip really means regression to the mean. And I prefer playing that outlier regression to the mean when the structure of the market is firmly higher, preferably, or firmly lower. Uptrends are more predictable than downtrends. So buy the dip is still alive and well, but it's in different corners of the market, because as of that Jackson Hole Powell event, what happened to the broader averages? So to your point, what happened to the trends? They were broken. We had a trend on daily S&P. Powell in one fell swoop crushed that trend. So buy the dip is no longer a viable strategy once the trends are broken. Once those trends are no longer 8, 13, 21, 34 double greens, then we move on to corners of the market where we do have trends. And then remember, a broken uptrend is not a downtrend. Although the way you hear people talking now, this is the beginning of the end, right? But broken uptrends are not downtrends, it's chop. And according to Charles Dow, and a century's worth of that being, look, Charles Dow was sharing his ideas 140 years ago. Dow theory was codified not by Charles Dow, but posthumously. And we're still talking about Dow theory over a century today because it just works. The tenets of Dow theory, 5 out of 6 of them really still work. And the only reason that one is not applicable as much, which was his tenet about the industrials and where the Dow goes, those two sectors and the broader average were weighted very differently in Dow's era than today. That's the only reason it's not as applicable anymore. So one of his tenets was just when a trend is broken, still operate with the bias of the trend that was. So I call it respect the trend that was. So broken up trend still carries with it bullishness, but it's chop. So we look for oversold support. We use a stochastic. We use something that's going to identify where something's oversold and out at a support level. All right. Okay. Next up. Hey there, Amit. What key macroeconomic data websites do I refer to and how do we interpret the data from them? Amit, that's a huge question. So let's tackle the first part. Which macroeconomic data sites do I look? So macroeconomic data, well, there's a lot. First, let's start with the calendar, right? I think one of the basic tenets of macro is know when growth, inflation, and job numbers are being released, right? That's huge. The second part, the most important macro as far as I'm concerned right now, this is sort of the punchline to all macro, which is courtesy of the CME, the Chicago Mercantile Exchange, looking at the target rate probabilities for where rates will be in December of this year and where rates will be in February of this year. So I would highly recommend that site. And the interpretation of that is how many more hikes. Can you imagine? There is a tool for this. We don't have to sit around and speculate. Remember, speculation and hyperbole and fear mongering, which I see on the internet, which I see on television. Gang, remember what it's designed to do. For television, they want you to tune in. Their advertisers need to run their ads and they need you tuned in. So what better way than to scare you with hyperbole so you'll tune in? Even better, if you're so scared, you won't want to manage your own money. You're going to give it to somebody else. And that's their job, to separate you from your investment money so they can manage it and charge you a fee. That's the machine at work, right? And on television, the machine at work on, say, the internet and social media, not that different. I never want to fearmonger. If the market's heading lower, there's opportunity. If the market's heading higher, there's opportunity. If there's chop, there's opportunity. And mixed within all that, how can we position size and place stop losses in such a way that we are not threatening risk of ruin? Our job as traders is clearly to find the beneficial trends for our style, which for me is usually an up or down trend, and then position size in such a way that if I'm wrong, I don't destroy my account. Everything else is just sort of window dressing or preference. You know, what kind of trend do we like? What kind of tools do we like? What kind of strategies do we like? Do we like futures over, say, options? That's preference, right? But the basis that we all have to build our trading career on is, what environment do we like and how do we control risk in that environment? Period. So if this helps me understand where the rates are likely to go, and the sooner we can all broadly agree that, okay, this is where the Fed's taking rates, the sooner we find wherever the bottom is, we can get to work. And what are we going to discount next? This is the great part. Once we know what their high is for the target rate probability, we start guessing at when they're going to start cutting rates. And that's when you see the market start rallying again. I know. It's pretty ridiculous, but that is the way in which the market most often works in these monetary policy shifts. All right, Ford and Lowe's. Ford was in an uptrend, in neutral now. Stick with the upside, Mr. Walker. Stick with the long side of Ford as long as it's trading above the wave. Lowe's, be a little bit more careful with Lowe's. Lowe's is going to be a little bit more about, let's let the slow stochastic get oversold. Let's see if we can't find a Darvas level support or a minor low to take advantage of them a little bit more aggressively, but also to the long side. All right, Schwab, let's take a look. Schwab is, let's see. I like Schwab to the long side. So we don't have a red grab candle here. We still have good support in the wave. We've gone from green to neutral. So we're in mostly a bullish. So this goes back to what Charles Dow talked about. Respect the trend that was, right? Respect the trend that was. Is a broken uptrend a downtrend? No, it's chop. I'd like to see it continue higher. That's likely the path of least resistance. But you also want to take a look at what's happening broadly at the financials level. All right, any comment on crude oil since there will be an OPEC meeting on Monday? So Phil, great question. I'm going to show you all another site within the CME. And I think I have this handy. Oh, okay. Well, let me dig it up. So this is the CME OPEC watch. Just like we can have a Fed watch, CME has an OPEC, not OPECs, OPEC. There we go. CME Group OPEC watch tool. I'd keep an eye on this because this is going to give us an idea of what kind of output increase or decrease. So I would say I would not expect much because you see how there's very little expectation for a change. That's what's factored into the market right now. If there's an output decrease, look for crude to go higher. If there's an output increase, which is marginally a little bit more possible than a decrease. But what's most probable? Just unchanged. And that's what I'll look at. So you can search, what did I search? CME OPEC watch, or just look at that CME Group OPEC watch tool. Google that. And this is what I use for that there. I hope that makes sense. And yeah, stock hands, I'll tell you what, I've been with Simpler now since 2012 or 13. It's been such an honor to be, for thousands of traders, their coach or their mentor for whatever length of time. Look, my job here is to take the 30 years that I've been trading and more importantly say, look, gang, in those 30 years, I've never blown up an account. And I don't want you to either. That is what I'm doing. I love having a community that's very self-serving. I love having folks to share my ideas with. And that's what I'm looking to do. Teach you how to find trends, teach you how to manage risk, and bring to the table 30 plus years of doing this, mistakes and everything. And so I appreciate that. What's impressive is the fact that, you all are learning. I mean, this is a difficult thing. It's a difficult thing to embrace because a lot of folks maybe around you don't necessarily know how hard you're working and how diligently you're working to be really great at this. They don't know the feeling. Most folks don't know what it's like to be a trader. And that's why I like the community. So I think what y'all are doing is even more impressive. I've been doing this a while, right? At this point, I'm my own worst enemy. And you all hit that spot eventually too. The market is not your enemy. That person in the mirror is. So what's impressive is how much time and dedication on a Sunday, for crying out loud, that you all are putting in to become better traders. So that's a lot more impressive to me, stock hands. But thanks as always, everyone, for tuning in. We will have a charts and coffee tomorrow, 9 o'clock, 9 to 9:20. We'll have our typical charts and coffee tomorrow. And I will see you all then. All right. Enjoy the rest of your day. Thanks as always for tuning in. Be good to each other.